We'll kick things off. All right. Hello, everybody. Welcome. I want to thank everybody for joining us for today's PA Presents webinar, Managing Your Life and Money. My name is Tyler Welsh, and I'm the Associate Director of Campus Constituent Relations here at the University of Pittsburgh. Before I hand things off to our speaker, I just want to go over a couple logistical notes. As always, thank you in advance for your patience for any potential technical issues. Knock on wood, hoping we don't have any difficulties. But if you do, please visit support.zoom.us. And I'll also note that you'll see at the bottom of your screen, there is a Q&A box. You won't be able to turn on your video at any time, but you are free to ask questions to our speaker. So you can type those in while the presentation is going on. After the presentation, you're welcome to ask questions at any time. If we don't get to all of your questions, we will address them offline. You're welcome to reach out to our speaker afterwards. But with that being said, let's get started. I'd like to introduce today's speaker. Today's speaker is Marc McCarey, who is Senior Vice President and Financial Advisor at Morgan Stanley. He focuses on holistic financial planning and has a deep understanding of the intricacies that comprise today's investment landscape. He's also a 2000 grad from Pitt Business. And with that being said, let's welcome Marc McCarey. Hey, Marc, how's it going?
Good, Tyler. Thanks for having me. Hi, everyone. Good afternoon. Really appreciate you taking the time to dial in. And as a fellow Pitt alum, again, thank you to Tyler Welsh and the entire Alumni Association for the invitation today. As Tyler had mentioned, my name is Marc McCarey. I'm a Senior Vice President and Financial Advisor with Morgan Stanley here in Pittsburgh. I have been in the financial services industry as well as with Morgan Stanley since I graduated from Pitt back in 2010. As both a chartered retirement planning counselor and a certified exit planning advisor. My primary area of focus is in the retirement planning space, but at the end of the day, and it kind of speaks to the presentation today, using the term retirement planning can be a bit misleading because planning occurs throughout your entire adult life, not just when you're getting ready to retire, so to speak. So today, we're going to be talking about navigating a few of life's major milestones, from graduating college to locking down your first job to starting a family and beyond. Each of you is on a unique journey for sure, and you will have different financial needs at different times. And we're going to cover a wide range of topics, highlighting some of the key issues that you will need to consider as you map out your financial future. So just a quick housekeeping note, there is a good bit of material in today's presentation and several topics to cover. So we may not have time for a lot of questions during this session, but I am going to be providing you all, and Tyler will be following up with my contact information, so you can feel free to reach out to me at any time. So for starters, as an introduction, let's talk a little bit about the concept of personal goals. At their core, all of today's topics are about helping you to get what it is that you want out of life. And that can be pretty tough to do without giving some serious thought to your greater life's goals. Defining your life goals as specifically as possible, as hard as it can be sometimes, it helps you to begin to establish priorities. And once you have those priorities, you can start thinking about what kinds of trade-offs you're willing to make to achieve your version of success on your own terms. Do you want to buy a house, or do you want to pay your way through med school? Do you want to donate to a charity or philanthropic cause that's important to you? Do you want to set foot on all 7 continents? These are all achievable goals, but unless you have substantial wealth at your disposal, I certainly didn't. When I first graduated and started at Morgan Stanley, I was still living on South Bouquet Street in Oakland. You may have to focus on 1 or 2 goals first and then prioritize from there. While making these decisions, you're going to want to think about what you want your short, medium, long-term path to look like, and you might not have any idea of what the longer term paths are going to look like, so you can start with the short term path. At some point, you may have to choose one goal over the other. So is it worth delaying home ownership to finance a trip overseas? That's really only something you can decide, and only if you've really thought through what's important to you. But once you understand what you do want, you can start to use all of the available tools to get there. So, graduating college, if you just graduated from college, you're probably maybe wondering, what now? What's next? Maybe you are heading home. Maybe you are still living in Oakland. Maybe you have a job lined up. Maybe you don't. In any case, to help to ensure you're prepared for what's ahead, it's important to understand how the financial decisions you make today can impact your opportunities going forward. So a little bit of a personal assessment. Look in the mirror, ask yourself the following questions. And by the way, I apologize for this stupid headset. My computer speakers weren't really working very well, so I had to don this headgear. So hold off laughing at me. The following questions: have you secured a job? Do you have employment as of now? Have you updated your social media profiles to help to ensure that you're portraying your most employable self? And we all know what that means, especially right after you graduate from college. Do you have a strong grasp of your skill set, how to position yourself with employers? So what is going to separate you from all of those other applicants? Can you define and demonstrate your strongest skills in a simple professional manner? Are you considering grad school? Is grad school necessary when considering your undergrad degree? Education, for example, if you want to be a teacher, oftentimes it helps to have that additional grad degree or a doctorate degree, not to mention in other professional areas. Have you decided what your next zip code is going to be? Where are you going to live? Have you thought about how to manage your cash flow in the real world? Do you have student debt? Do you have any other forms of debt, which we're going to talk about in a little bit? An interesting question. It's kind of a chicken or the egg thing, but which should you choose first? Should you choose your job or should you choose your location? Will your location dictate where you work, or will work dictate where you live? And as you're thinking that one over, keep in mind that statistically speaking, there's a very good chance you may switch employers at least twice over the next 5 years. To anybody who falls into the millennial or Gen Z camp on this call, just a heads up, statistically, nearly a third of you plan to leave your job within the next 2 years. So consider choosing a location that has more to offer than just your dream job. Some of the things to think about: the quality of employment opportunities. Take time to research the major employers in the area, dominant industries around the city that you're considering. One indicator of long-term career growth, for example, maybe the city's workforce, the share of the city's workforce that's employed in management or other professional areas. If you're hoping to work from home, make sure the city offers the necessary structure, infrastructure to support your success, like co-working spaces, shared interest community groups, and most importantly, a good Wi-Fi signal. Silly as that is to say. The quality of the workforce. It may be worth researching what percentage of 18 to 34-year-olds hold a bachelor's degree, as this can be an indicator of a city's economic potential. The cost of living, which is incredibly important, maybe the most important. Research housing options. Maybe one of the most important factors when choosing where to live. You need to focus on the median home prices or median home rental prices rather than the average, because the average can be skewed by a few outliers one way or the other. And while you're doing this, don't forget to consider taxes, property taxes, school taxes, things like that, if you're going to be owning especially. And as silly as this is to say and intuitive as it may be, the quality of life factor. It encompasses so many different things like climate, transportation, the restaurant and the bar scene, proximity to your family and friends, if you have children or plan to have children, education or childcare options, a baseball team that makes it to the postseason. So in Pittsburgh, that always seems to be a problem. So sell the team, Bob. You figured out where you want to live. The obvious next question is, can you afford to live there? You're more than likely going to have a whole host of new expenses like rent, insurance, utilities that you haven't had to worry about before. And this is going to be where a budget comes into play, where it's critical. When used as a guide, A budget can be incredibly empowering. Having a good understanding of your monthly spending and savings habits, it allows you to make smart financial decisions that will position you for success in the short, intermediate, and especially the long run. And on the flip side of the coin, budgeting can have the opposite effect if you're too restrictive. So your goal is to find a balance between living for today and saving for tomorrow. Quick step-by-step guide for creating your post-college budget. Step one is really, what are you working with? Figure out how much you have in your various savings and checking accounts. That includes investment accounts you might already have. These would be known as your liquid assets. Then you're tallying up any debt or outstanding loans that you may currently have, such as student loans, credit card debt, the latter being a huge no-no if you can avoid it because of the high interest rates that go along with credit cards. Those are known as your liabilities. And then you're just going to calculate how much income will be coming from your new job or your internship each month, and make sure you calculate your total income after taxes. Step two is just estimating your expenses, and that's broken out between fixed expenses and variable expenses. Fixed expenses are the ones that are always going to be there that you can't avoid, whether it's rent, insurance, car payments, things like that. The variable expenses are what I like to refer to as more of like the fun money bucket. That would be the money that you use to go out on the weekends, attend sporting events, pay for a golf membership, travel to visit friends, the stuff that you don't necessarily have to spend money on that you can adjust from week to week or month to month. Step three, creating a savings goal. Treat that like an expense. That's the best way to go about doing it. So in a vacuum, the average that seems to be the target that the textbooks say you should shoot for would be saving 10% of your after-tax income on a monthly or an annual basis. It seems like a lot, but if you automate your monthly deposits, you kind of get to a point where you forget about it and it's out of sight, out of mind, and it makes it a little bit more manageable. And you certainly don't have to start at 10%. You can start small, work your way up to it. Every little bit helps over time. And step four is basically just running the calculations and figuring out if you can afford spending and savings habits, deducting your expenses and your target savings from your monthly income after taxes. Ideally, you're going to have a small surplus. If you have a big surplus, it doesn't mean spend more. It means you might want to consider increasing your savings goal. So don't let it take you the other way. And if you end up with a negative number, you're obviously going to need to redo your math or scale back on your expenses and kind of revisit where your money goes on a monthly basis. So congratulations, you now have a budget. And then obviously the most important step, the final step, is to track your spending and try to stick to those goals. So shifting to another important area when it comes to saving, starting your career, starting your adult professional life, at some point in the future, if you haven't already, you may need to borrow money to reach your goals, whether it's starting a business or buying a car, or most likely what you tend to see most often is buying a home. And your credit report is basically your personal financial report card. The creditors look at, the lenders look at. The report gives you a 3-digit score ranging from 300 to 850 that basically tells lenders how risky you are as a borrower, how big of a liability are you as a buyer. Every time you pay your credit card balance or repay a loan, the transaction is reported to one of the credit bureaus that counts towards your overall credit score. FICO score, it's calculated from information contained in your credit report, and it's grouped into 5 categories shown on this pie chart within this slide. Some of them have heavier weightings than others. The largest at 35%, not surprisingly, is your payment history. So paying your bills, especially your credit card bills, on time has the greatest impact on your credit score. 30% is your credit utilization ratio. So this is how much of your total available credit you are currently using. For example, if you have a balance of $1,000 on a card with a $5,000 limit, your credit utilization ratio for that card is 20%. And generally speaking, the lower your utilization ratio, the better. 15% is your length of credit history. The longer you have credit, the better you look to lenders as far as less of a liability. You know what you're doing. You've been around for a while. 10% is types of credit used. There's several types of credit that can influence your credit score. In addition to credit cards, your credit score takes into account things like car loans, mortgages, student loans, several other forms of debt. Generally, having multiple open lines of credit can help to boost your credit worthiness, as it shows you've been approved by various lenders, but that doesn't give you a hall pass to rack up balances on all of those lines. So you can have a lot of lines open. It doesn't mean you're utilizing all of them. And then finally, 10%, the number of hard credit inquiries. Hard credit pulls, basically, if you go in to buy a car, they run your credit, that's a hard pull. If you contact a bank and try to get a loan to buy a house and they pull your credit, that is a hard credit pull. So every time they do that, it's reported to the credit agencies. If you do that too much, it may give the impression that you're not getting the loan that you're looking for at one institution, so you go to another one, and then they try it again, and they try it again. So everything kind of piggybacks on one another. So something important, you can request a credit report from one of the 3 national credit bureaus on an annual basis. You can do this online. The big 3, there's Experian, Equifax, and TransUnion. So you can request one of these on an annual basis. There are other third-party sites that give you the ability to look into free credit reports like Credit Karma or freecreditreport.com. But keep in mind, they are pulling all of that information from the big 3 national credit bureaus anyway. And aside from the obvious, you may be wondering who is interested in your credit score. So you can see on this slide, utility companies, mortgage lenders, home insurers, your employer. Employers typically will do a credit pool just to make sure you don't have a ton of outstanding debts or liens or any type of bankruptcy obligations, things like that. So the next section, starting your first job, if this is where you are in your life. I'm the first to admit that starting your first job can be a very nerve-wracking experience, but it is the first step to finding both a career and financial independence. So it's very important to get your ducks in a row ASAP when you're at this stage. There really are an endless amount of career paths out there, as we all know. So where do you really start? Some things to think about, a short list of self-evaluation questions that could be useful for defining your work personality and your preferences. How do you deal with uncertainty? High-risk jobs, low-risk jobs. How much flexibility do you have? Are you at a point in your life where you can explore a wide variety of options right now and sort of play it cool and put a lot of feelers out there? Do you have to take a job right this second, or can you wait and then explore some different avenues? How would you describe your preferred work environment? Stressful, steady Eddie, easygoing, very regimented? How much structure do you need getting back to being regimented or lack thereof? Are you willing to put in time and effort to build your personal brand if you're a startup or you're starting a business? Describing your working style, and how motivated are you to learn new things? Do you just want to be hired to do the exact same thing on a day-to-day basis, or do you see yourself as wanting to have opportunities to sort of migrate in different directions working for the same company? Some of the previous questions can help you to clarify which work environment may be most suitable for you. We were talking about some of those different items, whether it's stable, variable, uncertain. If you prefer a stable, structured environment where your hours and your benefits are clearly defined, then the corporate world may be a good fit for you. If you're looking for an opportunity to be sort of on the ground level, integral part of building something, and you're willing to deal with less uncertainty for a period of time, or less certainty, I should say, maybe you consider joining a startup in the tech space. If you're drawn to being in control of your own destiny, you want to make your own hours, if you work best when you don't have to report to a boss, then maybe freelance, contractor work might be up your alley, in addition to maybe starting your own business. A big part of a job search is timing. Timing can be pretty impossible to control, but good preparation can help to ensure that you're ready for whenever the right opportunity presents itself. Start by sprucing up your resume. Don't be afraid to let your creativity show in there to make you stand out from the rest of the pack. You're probably going to want to revamp your online presence. Remember to keep professionalism in mind and establish a LinkedIn profile, for example. Remember that your network may be the most powerful tool in your arsenal, regardless of how old you are or where you are in your trajectory of your professional life. Between people you already know, family contacts, friends of friends, alumni circles, you have an ever-growing list of people that may be appropriate to reach out to. And as far as leveraging your network is concerned, do your research. Make sure you know the professional background of the person you're talking to. It may also be helpful to prepare questions in advance that you can use so that you can use your time efficiently and get the information you need. And if you're doing a virtual interview, it's a good idea to make sure you certainly have the right software and technology to connect. We've all been on conference calls and Zoom calls where there's always the one person who can't seem to get the technology figured out, and it drives everyone crazy. So you really only get one shot at these conversations. You want to make sure you make a good impression. The most important thing, don't forget to follow up. Following up is critical, not just because it's polite, but because it's another opportunity to demonstrate your professionalism and how eager you are for that relationship or that position. Don't be afraid to ask questions, whether it's for an introduction or a follow-up meeting. Really, the worst thing that can happen is somebody says no. So that never killed anybody. When the job offers start rolling in, again, you need to weigh your options. Getting back to what we discussed a bit ago, you should be considering some of the following, such as, the role itself, opportunity for growth, the people you're working with, the lifestyle that you would have, or what it could give you down the road, the purpose of that role. Are you making a difference? The type of money that it pays, as well as the location. Negotiating is a very important part of your professional growth. As you can see from some of the statistics on this slide, most managers expect a salary negotiation. They expect you to come in with a number and push back, and these negotiations can often result in a substantial salary increase. Shifting gears a little bit, selecting employee benefits. As a new employee, you may have some HR forms and logistics to finalize before you actually dial in. In addition to having to fill out a W-4 form, which is a tax form, it tells your employer how much of your salary to withhold for tax purposes. You'll likely need to select your employee benefits. It can seem complex, but educating yourself about benefits prior to signing the new forms can make the process a lot less overwhelming. The biggie from benefits, or the two biggies as far as benefits go, it's your 401k if you're offered one, or your retirement benefits, and then your health insurance benefits. Typically, a 401k is offered. It's a company-sponsored plan that allows you to save a portion of your money for retirement. If the company offers a 401k, you can basically tell them how much of your salary before taxes you want to add to the 401k. So it gives you the pre-tax money that goes in. You don't have to pay income tax on it right now. As a young professional, you may be tempted to minimize savings to maximize your income, but a 401k is an easy way to start prepping for your financial future, especially because of the compound interest, which is a fancy way of saying that your interest earns interest and you're doing it on a tax-deferred basis because it's pre-tax money that goes in there. An important caveat, this is a really important one, money that goes into a 401k, with very few exceptions, you won't be able to take your money out of the 401k until you're 59 and a half. It's a retirement planning vehicle, period. Some companies will match 401k contributions up to a certain percentage, and if your company does match, at a minimum, you want to try to take advantage of that full match, whether it's 3% or 4%, dollar for dollar. The other big one that I had mentioned, it's health insurance. It's incredibly important, even when you're in your 20s. If you're under the age of 26, you may be able to piggyback on your parents' health insurance, but after that, you're on your own. There's different types of health insurance plans out there. At the end of one spectrum, there's HMO plans, which are typically the least expensive and least flexible because they only cover in-network doctors, and you need to get a referral for anything if you have to go see a specialist. PPO plans, on the other end, They're the most expensive because they have the most flexibility, and they allow you to visit whomever you want without referrals. And there's certainly different plans that are in between. Next section is going to talk a little bit about savings, or saving, I should say. Once you start earning your own money, you're hopefully thinking about ways to go ahead and save it. For most of us, life gets more expensive as we take on responsibilities. Bills, more bills means less disposable income. Start saving now, especially as our lifespans get longer. Taking a look at this slide, for the millennial crew, this is an example of how much of your peers are saving and what they're saving for. So ask yourself, how do your savings habits stack up compared to that? So why is it important to start saving early? Really, it's just about compound interest, which I alluded to earlier. Albert Einstein actually referred to compound interest as the eighth wonder of the world. It's basically just a matter of your interest earning interest. So if you have $100,000 in a savings account and you earn 5%, you have $105,000 at the end of the year. The following year, you're starting with $105,000, you're earning 5%. So your interest, in addition to your original investment, is earning interest. So it's very powerful. And the example on this slide showing the power of compound interest, take Jane and John, for example. They're the same age. They both saved about $87,000 over a 25-year period. The only difference is that Jane started saving at age 25 and John waited until age 40 to start saving. And even though they saved exactly the same amount of money over the same number of years, by age 65, Jane has substantially more savings than John, about $560,000 more. The reason for that is her money had more time to grow. So the key takeaway is that starting to save earlier, by starting to save earlier, you can greatly impact the amount of savings you have down the road. And a general good rule of thumb, as I had mentioned earlier, is to save somewhere between 10 and 15% of your post-tax income. Start by saving for the basics. That's about 1 to 3 months worth of living expenses available in your checking account. Beyond that, it's nice to try to accumulate an emergency fund for the unexpected things that life throws your way. I typically recommend anywhere from 3 to 6 months worth of living expenses in an emergency fund. And then once you've saved enough to cover your day-to-day expenses and your emergencies, you can really start planning for your longer-term goals. Understanding retirement accounts, just to a brief overview, to encourage people to save for the future, the government created several tax deferred accounts. And this means that over the years, the contributions or the money you put in can grow faster because the taxes are being deferred. I had mentioned a 401k earlier, but there are several other options as well, like IRAs, Roth IRAs. On this slide, you can see some of the most common types of retirement accounts, all of which I'm happy to discuss with you in further detail offline if you have an interest in doing so. So beyond saving, you get into investing. And remember that saving is a prerequisite to investing. You really need to make sure you have enough in savings to cover your monthly living expenses and emergencies before you begin investing money in the markets. So with respect to familiarizing yourself with investment terminology, take a look at some of the terms on this slide. How many of them look familiar to you? By putting your money to work in the markets, investing can help you to achieve higher returns than a savings account alone. However, there's potential for higher risk as well. Higher returns comes at a price. Investing involves more volatility than saving, and as a result, the risk of losing your money is considerably higher depending on the type of investment you're utilizing. There really are many different ways to invest. What I deal with on a day-to-day basis with my clients, we call these different vehicles asset classes. Basically, an asset class refers to a particular type of investment or category of specific investments. And there's 3 main categories or classes that you should know about. There's cash and cash equivalents. Generally, the money you hold in cash and cash equivalents is meant to be the liquid part of your total assets, meaning if you needed to access something right away, there it is. Bonds, basically an IOU. A bond allows investors to lend money to companies or governments for certain amounts of time in exchange for interest payments until the money is repaid. It's just like the savings bonds that your parents, grandparents, great-grandparents may have purchased in the past. They're not as popular these days. And then a stock, when you buy a stock, you're buying a piece of a company, also known as a share. The value of the company and your stock price on any given day is determined by supply and demand. When a company is growing, doing well, making money, there can be more demand for stock. The value of your shares can increase, and the flip side of the coin applies as well. So moving on and shifting gears again, another milestone. Let's talk about what can be one of life's biggest milestones. That's getting married. Tying the knot has both personal and financial implications for you and your partner. By understanding the expectations and setting common goals, there are a lot of ways you can build a healthy financial foundation for the future together. Marriage is about compromise. One of the best things you can do to help ensure the success of your relationship is to get comfortable talking about money early on. On this slide, you can see some questions that may be helpful conversation starters for you and your partner. And as newlyweds, you may be able to take advantage of certain tax, legal, and savings opportunities. So for example, if one spouse earns significantly more than the other, you may qualify for a lower tax bracket when filing jointly. Another example, in the event that one of you is supporting the other financially, you can do so by making tax-free gifts. And once you're married, if one spouse isn't working, the working spouse can generally contribute to the non-working spouse's IRA. One of the most frequent questions I get from newlyweds is, do we combine bank accounts or do we keep things separate? Let's start with joint accounts. As common expenses like mortgages and childcare costs begin to accrue, joint accounts may simplify your household finances. If only one partner works outside of the home, it may also make the stay-at-home partner feel more integrated into the family finances. On the downside, full visibility into your partner's spending may not always be desirable. You know, do you want to know how much they spent on your Valentine's Day present, for example? As silly as it is, those are things that come into play. For separate accounts, on the upside, many people find that having their own bank account gives them a greater sense of independence. On the other hand, separate accounts may be less convenient for paying those joint expenses like the mortgage or the rent bill. Some couples find it awkward to keep a running tally of who owes what, and there may be a conflict over what constitutes a joint expense and what doesn't. So when in doubt, you can always do both, and that's what I tell a lot of clients. You can set up a joint account for your shared expenses, keep an individual account for individual expenses. Let's look at buying a home, which is another milestone. So it may be the first big investment decision of your adult life. It typically is. Your first house is more than simply a roof over your head. It's the home where you will settle down, entertain friends, raise a family, and start building equity in a tangible asset. But before taking the leap, it's important to evaluate a variety of factors like the real estate market, the total costs of home ownership, and available financing resources. The first question you need to tackle is whether or not it's the right time to buy, but in full disclosure, realistically, there's never going to be a perfect time to buy. Some of the benefits of owning versus renting: when you own, you can take advantage of appreciation within the asset. Typically, when you buy real estate over time, you see an appreciation. If you sell it down the road, you can take advantage of the capital gains there. Along the way, you can also build equity in that home, and that's basically the original loan minus the payments that you've put into it. That amount that you've put in is your equity. And there are typically some tax advantages that go along with owning as well. For instance, certain kinds of expenses related to home ownership may be deductible from your federal and state income if you itemize. And forgetting about owning for a second, there are definitely benefits of renting as well. Compared to buying a home, the initial costs are typically much lower, usually just a refundable maintenance deposit and perhaps a rental agent fee. If you want more space, decide you don't like your neighborhood, or you get a better job, you can basically just wait until your lease is up and take off, or you can try to get out of your lease early. In addition, if you own a home and the furnace needs replaced, or if a water line breaks, you have a sudden large expense, but that's not a problem if you're renting. That's up to the landlord. So the responsibility of buying a home may seem doable when you compare your potential mortgage payment to your current rent payments, but the reality is that home ownership involves a number of costs that often go overlooked. It's not front of mind. So before you commit, both financially and emotionally, into buying a home, you need to consider the collective costs carefully to avoid potentially ending up what they call house rich and cash poor. There's things like the down payment, closing costs, earnest money or hand money. There are property taxes when you owe. There's school taxes when you owe. Homeowners insurance, which you need to buy to protect your home in case something happens. Utilities and maintenance, again, bills, bills, bills. And then what I'll call the beautification budget, expenses associated with renovations, interior decorating, DIY projects. If you're upgrading to a larger space, you typically need to buy more furniture to fill it. So you basically need to make sure your budget also accounts for a lot of those bigger ticket items, along with some of the smaller costs, such as paint supplies, cleaning services, home decor, as well as movers. So before we move on to the next section, let's just review some of the common mistakes of new home buyers so you can avoid them. Pretty common sense, overestimating what you can afford. We were just talking about some of those other costs that not a lot of people think about right away. Failing to communicate what's important to you to your real estate agent, overextending credit too early in the process tends to drag out when you're in a real estate transaction. You want to make sure that you're not going to get caught where the open line of credit is going to only be good for a certain number of days. Assuming your first offer will be accepted, there's typically a negotiation process. Skipping the home inspection, which can be scary. You don't really know what's behind those walls or under the floor. Not including a financing contingency in the contract, or locking in your rate too soon. Starting a family. This is the biggie. This is definitely the biggie, starting a family. So a statistic for you to consider. As a preface, the cost of raising a family can vary significantly, pretty darn significantly, depending on location and lifestyle. But just as an example, the average tuition costs for private high schools in a place like New York City, it's about $25,000 per year per child, just to put it into perspective. According to Baby Center, 70% of new mothers say they're more anxious about money since having a child. So it definitely makes you think about the things that you haven't necessarily thought about. When you have a baby, your monthly expenditures will absolutely change with an additional mouth to feed for sure. I have 2 young children, so I know. My daughter Lila is a grazer and my son Cameron's more of a garbage disposal. For many, having a baby might bring about a temporary or more permanent decrease in household income, so something to keep in mind. Before making the decision to have a baby, you probably want to discuss these important topics with your partner. So for example, how will you handle the caretaking responsibilities from a time standpoint as well as a cost standpoint? Are you financially ready to support a baby in addition to one-time prep costs such as buying a car seat or a stroller or a diaper bag and a crib? You're going to have ongoing costs such as diapers, wipes, food, clothing, healthcare, the list goes on and on. Do you share the same approach to teaching or disciplining your children, raising your children? These are important things to talk about. It's good to get on the same page with these items before you have a crying baby at 2:30 in the morning. And anybody who's on the call right now that has children can certainly relate to that. So taking time off work in the US, when it comes to time off work, the only thing most American mothers or women are guaranteed from the government is job protection from up to 12 weeks after birth or adoption, thanks to the Family and Medical Leave Act. The rest is up to the discretion of your employer. Maternity and paternity leave can typically consist of a family leave policy or a short-term disability policy. Family leave is usually weeks of paid, partially paid, or unpaid leave given to any parent, mothers, fathers, adoptive parents, for the purpose of caring for a new baby. Parents may start 12 weeks before birth, if desired, or once the baby is born. less than 15%, to throw another statistic out there, of private employers fund paid maternity leave programs today. It's kind of surprising to many considering what other countries currently offer, but that's what we're stuck with here in the US, for better or for worse. Short-term disability leave is usually 6 weeks of partially paid or paid leave given to new mothers for medical recovery after birth. Salary during disability leave can vary depending on your salary, your pay, length of company employment, insurance policy, and state regulations. And some companies may allow you to include your outstanding vacation time or sick days in maternity leave as well. And while the FMLA technically covers fathers as well, the Family Medical Leave Act, there are fewer companies who offer or promote paternity leave. So looking ahead, there are also other expenses you will need to pay for, presumably, like higher education, which according to recent statistics will run roughly $40,000 per year on average using today's dollars. And it's only going to go up from here, I hate to say it. So to discuss a few common savings vehicles that most of you are probably familiar with, 529 plans, probably the most common because it can offer the most flexibility, significant tax benefits, and degree of control for the account owner. There are no age or income restrictions on who can contribute. 529 plans offer high contribution limits in excess of $200,000 depending on the state, which enables the account owner in most cases to accumulate significant assets to cover tuition costs fully. Contributions grow tax deferred, and if you take the money out down the road for education costs, they are free from federal taxes when used for those qualified expenses. In many states, contributions may also be deducted from state income tax. 529 plans aren't all great, though. They do have some limitations. Funds cannot be used for K through 12 expenses without a 10% penalty. In addition to ordinary income tax, 529 plans can be used for in-state, out-of-state, or international institutions as long as they're used with an accredited program. Qualified expenses include things like tuition, fees, room and board, your books, your laptops, supplies, other related technology services, including software and internet access. And something important to note, 529s aren't just for traditional four-year degrees anymore. They can be used for other higher educations like trade school, beauty school, things of that nature. Also, if you have two children, you can transfer the 529 balance from one to the other. So if you have a child who gets a full ride or doesn't decide to go to school, you can always change it over to the other beneficiary's name, and it doesn't just have to be siblings. In a Coverdell account, you're getting most of the same bells and whistles of a 529, but there's some important differences there. Contributions may not exceed $2,000 a year, and you have to make less than $110,000 or $220 if filing a joint return per year. The account must be established before the beneficiary reaches 18 years of age, and the funds have to be used by age 30. And then the third option, which I'm not going to really spend any time on, the Uniform Gift to Minors Act or Uniform Trust to Minors Act account. Basically, you can put money in there. You have control of it as the owner until the child or the beneficiary turns 18. The catch is once they turn 18, they can use that money for whatever they want to use it for, and you cannot control it anymore. So if they want to go out and blow it at the casino or buy a car, you can't do anything about it. So again, the 529s tend to be the most popular option for the bells and whistles and the protections that they offer. The last section here, creating a legacy. Really, only you know what you hope your legacy will be, but a common denominator here is typically protecting your assets and your loved ones and passing on your values to those beneficiaries. It's not the most enjoyable dinner table topic. I say to my clients, you never wake up in the morning and say, let's go do our wills and our powers of attorney, but it is an important topic regardless of your age. Even if you're just starting to build your wealth, having a basic understanding of the steps involved in estate planning can be helpful in the event that your parents or grandparents look to you for support. Without a proper plan in place, A family crisis can have very, very expensive consequences for everyone involved from a personal, legal, and tax perspective. Even though your parents may be in great shape today or your grandparents may be in great shape today, and therefore they're reluctant to think about making end of life plans, it will give them peace of mind to know that a family member is privy to their wishes in the event that something unexpected happens. So whether you're creating your own estate plan or you're helping loved ones with theirs, consider including some of the following in the discussion or in the document. So a fiduciary, this is a person who is legally appointed, authorized to act on your behalf in the event that you're no longer able to make decisions for yourself. An executor, for example, this is a person or an institution, typically a bank or a trust company, responsible for settling your estate according to the terms of your last will and testament, including distributing your assets, paying any outstanding debt, and preparing the estate tax and income tax returns. A guardian, which is another type of a fiduciary, this is a person named in your will who will be responsible for caring for your children in the event that you pass away before they reach the age of majority, typically age 18. If you have no will or your will doesn't name a guardian for your children, the guardian is selected by the court system, and that's pretty scary if you have children to think about. And then a healthcare power of attorney, also called a durable power of attorney. This is the person responsible for making healthcare decisions in the event that you're incapacitated. So if you're in an accident, you're in the hospital, the doctors can't ask you if you're in a coma if you'd like for them to operate on you. So this is the person who can make those decisions on your behalf. So at some point, getting back to previous generations, your parents, your grandparents, at some point you may find yourself providing care for aging parents. By engaging your parents or grandparents, siblings, other family members in a proactive and thoughtful discussion, you can help to avoid the emotional complexities of making difficult decisions during times of crisis or medical emergencies. Help to ensure that you and your loved ones are able to age comfortably by potentially looking into long-term care insurance. But I will tell you that it's become incredibly expensive over the years, and there's not a lot of providers in the space these days. So it's a good idea to run this by your financial advisor or your insurance agent before committing to anything. And the last thing I'll say, and I deal with this very frequently in my line of work, is to take the time to organize personal and financial information, as it can save you and your family a ton of hassle, stress, and money. Here's a little list of some of the key information to have prepared in the event that something happens. If you want to take a little screenshot of this on your cell phone, take a picture of it while I have it up on the screen. It's very helpful. I would recommend creating a folder or a 3-ring binder with important information and contacts and store it somewhere secure. Not at the bank in a safety deposit box, because people always seem to die on the weekend or in the middle of the night when the bank's not open and the banks are closed. So it always seems to happen that way. I don't know why. So I know I went through a lot today, but in summary, I'd like to just reiterate that all of today's topics, maybe not the estate planning part of it, but it is very important. They're all meant to be positive conversations. So make them positive before they become negative. Take a look at it now rather than waiting and having to revisit something last minute or visit it for the first time. These are all incredibly exciting milestones for you, again, aside from the estate planning, but very important regardless. But the more you plan now, the better the experience will be down the road. So just take everything one bite at a time instead of trying to drink through a fire hose. And with that, again, I'd like to thank you all for spending some time with me today. I certainly would love for an opportunity to answer any of your questions offline. I know we only have a few minutes left. Not sure if Tyler wants to read one or two off, but I certainly would love the opportunity to assist you with your own planning efforts if you have them. So please feel free to reach out to me directly using my contact information on this slide or through LinkedIn. Truly, I'm here to help in any way that I can. especially for some fellow Pitt alums. So to Tyler and the rest of the Pitt Alumni Association, thank you again for the invitation. I really always enjoy working with you guys, and I look forward to our next get together. But at this point, Tyler, I'll go ahead and turn it back over to you. So thanks, everybody.
All right, awesome. Thank you very much, Mark. Appreciate it. Great info. So much great stuff there. At this time, we do have a few minutes left over. If anybody has any questions, you're welcome to type them into the Q&A chat box, and we can address them here live. You'll also see what has popped up on your screen is a quick poll that has come up. So if you could just take a quick second just to answer the poll. We would just like to kind of hear your very brief feedback or just a score on what you thought of the presentation. So I'll give you a minute to fill that out and then a minute for questions. And as you're doing that, I'll just reiterate what Mark has said. I know there's a lot in here and lots of different topics, no matter where you are, what phase in your life. You're welcome to reach out with any additional questions on any topic that pertains to you over here. So just checking to see if any questions have come in through over here. I know some people have things to get to, so they're signing off over here, but that is fine. We can connect afterwards too. Looks like we did have one that came through. So we'll look at this over here. Yeah, we can answer this one live over here. I don't know if you can see the question too, Mark. It says, "What is favorite recommended book or recommended book on personal finance related topics?"
There's actually a couple. I mean, a lot of my the books that I'm typically looking at are more investment related. There's a book that's great. It's very small. It's called The Little Book That Saves Your Assets. It's a little purple book. I had it somewhere. I'm not sure where exactly it is right now. Let's see if I can find that. Another great book, and this is one that I'm currently working on that it's for further down the road when it comes to financial planning. It's called Getting Paid to Wait. It's a book about Social Security, and it talks a little bit about whether you want to take it at age 62 or wait until your full retirement age. There is a book out there. The title is so arrogant, and I hate the title of the book, but it talks a little bit about real estate. It's called Rich Dad, Poor Dad. Absolutely hate the title. I think it's so arrogant, but it is a good read, and it is very interesting. But I've I've often found that a lot of the best articles regarding personal financial planning, not just for because a lot of the books tend to be more geared toward people who are getting ready to retire, but a lot of the articles that you find on CNBC.com or Investopedia.com, a lot of those are fantastic when it comes to just giving general information regarding how you can start to tackle different phases of your life.
Cool. I'll have to check that out as well. Thanks for sharing, Mark. One other question that we had over here too. We talked different things about finance, saving between 401ks, and different things like that. What is kind of your expertise between splitting your savings between your 401k, your personal savings, and then like a high yield versus like a CD?
Yep. So once you get above and beyond having your day-to-day expenses and that little bit of a cushion in emergency funds, I tend to try to get people to max their 401k out up to the applicable limit, which is somewhere above $20,000 on a given year, depending on how old you are. Minus under the age of 50 crew, over the age of 50 crew, you can put a little bit more away. But a 401k is the only vehicle that's going to allow you to defer money on a pre-tax basis. Above and beyond that, you have to pay income tax on it before you go ahead and reinvest it. So I would say that if you're offered a 401k plan, try to get yourself to a point where you're maxing that 401k out. And then above and beyond that, try to max out an IRA or a Roth IRA contribution, depending on what your income limits are. And then above and beyond that, then you can start to put some money in a non-retirement account, a single account, or a joint account if you're married or have a partner. But you tend to want to look at it in that hierarchy as far as your employer plans first. At a very minimum, take advantage of the match, try to max it out. then try to max out your IRA contributions, and then move on to your non-retirement investment accounts.
Great, thanks, Mark. I'm going to close the poll. Looks like our last question that is in here. Yes, this is being recorded. We're going to share this out. That was actually my closing speech over here, anyways. Is that yes, there will be a follow-up once again with Mark's information. We'll share the recording out. Once again, you're welcome to reach out, view the recording, and your own time as well, too. So that being said, if we don't have any extra questions, like I said, we can still address more offline and everything. But I just want to thank all of our attendees for viewing today. And also, Mark, thank you again for being here. This was great stuff, and we appreciate seeing you again sometime. So,
no, thank you so much for having me, and thank you everybody who dialed in, and hope to do it again soon.
cool. Well, have a good one, everyone.
All right.
Out the pit. See
Thanks.
you.
Take care. Bye-bye.